Bismillahirrahmanirrahim. This is the first video on accounting for healthcare organizations. In this video, we are going to talk about indemnity coverage, capitalization coverage, revenue for hospital, third party reimbursement, capitation fees revenue, and direct care services. All these concepts will be explained with the help of an illustration. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video helps fresh graduates who have joined the governmental or not-for-profit organization and want to refresh their learning on indemnity and capitalization coverage, revenue for hospital, and third-party reimbursement, capitation fees revenue, and direct care services. So let us start with the concept of indemnity coverage. One of the main reasons why people from several third world countries want to migrate to Western countries like America, Canada, UK, etc. is that they provide excellent healthcare facilities for its citizens. The prospective immigrants are also lured with this facility as the healthcare facilities are not only excellent but also free, and it is free for every citizen. It is free not only for those that are employed but even the retired people too. It is free for every citizen. Just think of the amount of burden that is relieved once the person knows that the health will be taken care free by the government, not only for his wife, his children, his parents, and he is not going to pay any money for it. So if anything happens to him or his family, he has to simply visit the hospital, and this is called indemnity coverage. It covers all amounts for which the citizen becomes legally liable. So the hospital treats the patient and bills for the services provided, and the insurance company will pay the bill. Now think about what this system means. It means that the insurance company will pay the bill and the patient don't have to pay anything. And since the hospital is going to receive the money for the services provided, the doctor will serve the patient as much as possible and bill the patient as much as possible, as the insurance company will pay all the services. So the system do not help to control cost by doctors or hospitals. And as a result, the cost of premium has gone up, and the insurance company could no longer afford to pay the premium. Unlimited coverage, no incentive to control cost, and inflation are the main reasons that indemnity coverage cannot continue. That's why indemnity is slowly diminishing even in the Western countries. And a new coverage called capitalization coverage came into existence. So let us talk about capitation coverage, which is a prepaid fees. Capitation fees or capitation rate is the fixed amount paid from an insurer to a provider. This is the amount that is paid generally a month on a monthly basis to cover the cost of the services performed for a patient. Capitation fees can be lower in higher population areas. Under a capitation system, healthcare service providers are paid a fixed amount for each enrolled person, whether or not that person seeks care per period of time. For example, a pediatrician may be paid 30 for each of the 120 children per month. So that means 30 times 120, and that is equal to 3600. Even though the doctor may end up seeing only 35 to 40 of them in an average month. In other words, the doctor is going to receive an average amount of $90 per each child visit in an average month. So the doctor or the hospital is getting paid because there is an insurance contract between them and the insurance company, and the patient don't pay any fees to the hospital. So the amount of remuneration is based on the average expected healthcare utilization of the patient. More remuneration will be paid for patients with extensive or complicated medical histories. Now, since the hospital is paid in advance, whether they treat the patient or not, the doctors don't have any incentive to treat the patient. Now, the hospital try to give the minimum amount of service, and other factors are considered like age, race, sex, type of employment, and geographical location. The capitation system provides financial certainty to both providers, that is, doctors and hospitals, and payers, that is, the insurance companies, in the aspect of care delivery. Providers assume the risk of more patients than expected falling sick and needing care. In the case of pediatric example, if a flu breaks out among the doctor's patients, he or she may end up seeing more people, not 35 to 40, for say they have say 55 to 60 children. That is 3-4 times more in that month, and the total number of visits is suppose 200. For so the payment is, or the average payment will be 18 per visit. Now let us talk about how the hospitals get the revenue, and the revenue comes from third party reimbursements and not from the patients. So let us talk about what is a third party patient. Now revenue will come maybe in a very small amount from the patients, but the majority is going to come, or most of it is going to come from the third party reimbursement, that is the insurance companies. Healthcare revenues is derived from third parties, and one of them is Medicare, which is a government program to serve the elderly and the retirees and the disabled if they qualify. We have Medicaid. This is a state program and is for low income group who cannot afford health insurance. It is basically for citizens who cannot afford to have insurance for their kids, families, and the third party is the insurance company. The insurance company might have indemnity insurers, capitation insurers, and a hybrid insurers, that is in between. For some services, it is indemnity, and for some services it is capitation. They limit the patient to a certain amount. Next, let us talk about how the mechanics of third party reimbursement work. So let us see how a third party reimbursement work. A third party paid the health coverage provider based on the contractual rate, and this rate is based on the illness. For example, for a open heart surgery, the hospital may charge 300,000, and if you want to remove a small wart, they may be charging say a very small amount, say 3,000 as such. And let us look into an example to see how this works. Now suppose a patient has an insurance cover and the doctor did a surgery. Now the patient received a bill for 3,850. The third party paid for EOB, explanation of benefits, say 2,000, and now the patient has to pay the balance amount of 1,850. Now what is interesting is that the hospital bills for 3,850, and when the patient submits the bill to the insurance company, they pay him 2,000. This means that the patient has to pay the balance amount. But you may be surprised that the patient is not going to pay the balance amount, as there is an agreement between the hospital and the insurance company for the amount the hospital will charge from the policy holders, and in this case it is 1,850. The insurance company has already paid the health provider, the hospital. Now, if the patient don't have the insurance, then he would be paying the whole amount, and that is 3,850. So this is a contractual adjustment, and it is the difference between the amount billed to the third party and the amount collected from the third party. So the hospital and the insurance company, they both make an estimate. The hospital will estimate how many operations they are going to do in the whole country at the same time. The insurance company will determine how many of these clients may get the surgery done, and based upon their own estimates they are going to settle for a price, and in this case the price is 1,850. Contractual adjustments recognize indemnity coverage. An independent patient will not get a discounted price. We have to keep this thing in mind. So contractual adjustment is recognized for indemnity coverage only. Remember, if the patient has indemnity coverage, there will be a contractual adjustment. So with health insurance coverage, some of the coverage may have indemnified coverage, while some of it could be capitation. So the insurance policy could have some illness that is fully covered, while for other illness there may be limited coverage. Let us do some general entries in this regard. Now, indemnity revenue. Now, the healthcare provider will recognize the revenue when the service is provided. That is, once the surgery is done, and not net of the contractual adjustment. So the service is recorded at the gross amount, and therefore the contractual adjustment must be shown on the balance sheet and on the income statement. So when the hospital billed the patient, They have actually billed the insurance company and not the patient, and the journal entry to record the revenue is debit third party receivable 3850 and credit third party revenue, that is 3850. You can notice that third party receivable and not patient receivable. And this is how we record the revenue and receivable for indemnity coverage. Next, we are going to record the contractual adjustment, and this is a contra revenue account. You can see that the revenue contractual adjustment, a contra to the third party revenue, is debited by 2000, and we are going to credit the allowance for 2000 also. This is also a contra account, and this is contra to the third party receivable. Next, the hospital will record the cash they will receive from the insurance company. So cash is going to be debit by 2000. Allowance for contractual adjustment will be debit by 1850. And I would like to, and the third party receivable will be credited by 3850. You can observe that after debiting the allowance for contractual adjustment, let me make a allowance for contractual adjustment. You can see over here that allowance for contractual adjustment is credited by 2000, and here it is debit by 1850. So it has a balance of 150. So, and you may be more wondering now that if a balance is left in a receivable allowance account when there is no corresponding receivable for it, what would this balance be for 150? How it is going to be recorded in the balance sheet if its corresponding third party receivable has been closed and it no longer exists? And the answer is bad debt accounts written off at the end of the year or as per the company policy. So that is how we are going to write off this 150. This account will not zero out, it will definitely have a balance. So we record the gross, then we record the contractual adjustment, and then finally we record the receipt of cash from the insurance company. Let us take a look at another example where no insurance is involved. Now during the week, the hospital bills 3 million to third party insurers for services provided to patients who have indemnity insurance coverage. Note, this is indemnity, it will not be recorded at gross. The hospital anticipated that third party insurance company to pay the amount billed but at a discount of 40%. So the agreement between the hospital and the insurance company is that they will pay 40% of the gross, sorry, they will pay at a discount of 40% of the gross bill. So let us generalize the transaction in the hospital. First of all, again it is third party receivable, and receivable is debit by 3 million, and third party revenue is credit by 3 million as we have done in the previous example, and this is the revenue that is expected from the various insurance companies. Then they will record the contractual agreement. The company will pay 60% as they will get 40% off from the hospital. So we are going to debit the revenue contractual adjustment, and if it is 40%, So 40% of 3 million is 4 threes are 12, 1,200,000. 40% 1,200,000. So the contractual adjustment will be for 1,200,000 and the allowance will be for contractual adjustment 1,200,000. Let us look into another example. Now here you see it is the insurance company that is going to pay at a discount of 40%, and let us look into another example where there is no insurance. Now, the hospital bills 1 million directly to patient for service provided to those patients. Now, the difference here is that we are billing and no insurance is involved. The hospital anticipates 65% of the patient charges are likely to be uncollectible, and that's a high collectible, but that is how it happens in a hospital. Let us record this transaction in the books of the journal. So first of all, we are going to record the revenue, and the revenue is 1 million, patient receivable 1 million, and this is the difference from the third party reference. We are billing directly, so this is patient receivable and not third party receivable, and we are going to credit the patient revenue by 1 million. Then we are going to record the debt expense or the bad debt expense, and as there are no contractual adjustments. You can see that 65% are likely to be uncollectible, so those are the bad debt expense of 65 million, 650,000, 65% of 1 million, and we are going to credit allowance for doubtful accounts for 650,000. Next, let us talk about capitation fees. Now, capitation revenue means all payments from managed care organizations, where payments is made periodically on a per member basis for a partial or total medical care needs of a patient. Payments are going to be made, and we have to look into two things. We are going to recognize the capitation fee revenue when cash is received, and the hospital may also provide the charity care, and a patient may have no health insurance coverage. They may not be having a job, or they may be homeless, they don't have any assets. So in such cases, the hospital may be providing medical care out of charity. So under such situations, the hospital would provide this as charity care, as they don't expect to receive any money from such patients. So let us look into an example. The hospital receives 7 million of capitation fees from the insurance company, with which it has contract during the year it provides services, for which it billed 9 million at standard rate. So they billed the patients for 9 million, and based on the agreement between the hospital and the insurance company, they will receive 7 million. Now don't forget that the capitation coverage we record when cash is received. Now since the hospital received only 7 million as revenue, therefore we are going to debit the cash for 7 million, and capitation revenue will be credited by 7 million. If there were no insurance agreements, then the hospital would charge at a standard rate of 9 million, But in case of capitation revenue, since we record cash, so it has to be recorded for 7 million. Let us look into another illustration. The hospital treated charity cases at a standard rate. It would have billed them 85,000. So for the month they have received services, they have provided services to people, and as a result they would have billed them 85,000, but they are not going to get this money back from the people. So therefore it is going to be considered as a charity, and there is not going to be any journal entry as no revenue is recognized. Let us look into another example, and this is on direct care services. Now, healthcare providers provided direct care to patient, billing them for 400,000. You can see this is a direct care. For this amount, the hospital received 120,000 in cash, but as a consequence of bad debt expense, they expect to collect a total of 330,000. So the hospital provided 400,000 worth of services, and it is expecting to collect 330,000, and we have already received 120,000 cash. So the first general entry will be to record the revenue. So we debit the patient receivable and credit patient revenue. But then we think we are going to receive only 330,000. So we are going to have bad debts, and bad debts are going to be for 70,000, and allowance for doubtful account is 70,000. Now, someone may argue that why don't we just debit receivable by 330,000 and credit revenue by 330,000? Well, the reason is that this is an estimate, and this is what we think that the hospital is not going to get. They may collect more than 330, or they may collect less than 330, and which is different from charity. In charity care, we are not going to get anything. We are not expecting anything. We are expecting a zero amount of revenue. So that's why we report it at gross and we write it down. When the hospital will receive the cash, then we are going to debit cash and credit receivable just like any other transaction. Let us look into another illustration. A healthcare provider provided direct care to patient covered by insurance. Now here the patients are not paying themselves. We are going to bill a third party who are members of various healthcare plans, for which at standard rate it would have cost us 650,000. However, owing to contractual agreement with the payers, it actually billed them only 480,000. So if the individual do not have health insurance, we would bill them for 650,000, and patients having health insurance, we are going to bill them for 480,000. And let us see how to record general transactions in case of contractual agreement. Remember that when it is a contractual agreement, we are going to record it at a gross. We have already talked about it. So to record the third party receivable or revenue, don't forget that this is a third party revenue and receivable, and this is not a patient revenue. So third party receivable is debit by 650 and third party revenue is credit by 650. The third party revenue, not a patient revenue over here. We are not expecting it from the patient. We are expecting it from the third party. That's why we record it as third party receivable. Then we are going to record the contractual adjustment, and we are going to debit revenue contractual adjustment of 170,000. It is 650 minus 480, it is 170,000. And allowance for contractual adjustment, this is a contra entry for 170. Then the hospital receives cash. Suppose they receive cash, as they have agreed, so they receive cash. So cash will be debit by 480. Now allowance is going to be debit by 170, and allowance for contractual adjustment will be credited by 650. Sorry, the third party receivable will be credited by 650. So the revenues and the contra revenue will go to the income statement, and that's how they are going to be closed out. Next, let us take one more example on capitation. Now, healthcare providers received capitation fees of 1.4 million from healthcare plan and provided services to members of those plans for which it would have billed at standard rate of 1.6 million. Now, remember, we are not going to record anything unless the hospital receives the cash, and once cash is received, we will record it as a capitation fees. So to record capitation fees, we are going to debit cash 1.4 million and credit the capitation revenue 1.4 million. Now there is no contractual agreement in this case, but if you can remember, when we had the contractual agreement, we made two entries, and then we recorded the recorded the cash received. So in total there are three transactions over here. Oh, this is a marginal, this is contractual agreement, this is revenue, receivable. Okay. So in case of contractual agreement, there are three entries, and in case of capitation fees, there is only one. So this completes the first video on accounting for healthcare organizations. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.